Welcome to the Economic Empowerment Podcast, where we break down the pathways to financial growth, investment opportunities, and building generational wealth. I'm your host, Ramel Lee, and I'm thrilled to take you on this journey beyond business into a world of possibilities that many don't have the access to see. Each episode, we deep dive into topics like alternative investments, real estate, hotel ownership, and much more, bringing you expert insights, inspirational stories, and actionable advice to help you take control of your financial future. Whether you're an experienced investor or just starting to explore new opportunities, this podcast is here to empower you with knowledge and tools to make informed decisions. But before we get started, I want to remind you, this podcast is for informational purposes only. The content discussed here is not financial advice. Every investment decision carries risk, and it's crucial to do your own research and consult with your personal financial advisor before taking action. Now, let's dive in and explore the exciting world of economic empowerment. Hey, good afternoon, everyone. Welcome to another episode of the Economic Empowerment Podcast. I'm Ramel Lee, Managing Partner of RDL Capital Partners, and I'm here with Paul Herbis of Equity Institutional Services. And we're going to talk about alternative ways to fund your investment strategy. So, Paul, why don't you tell the people a little about yourself?
Yeah, well, first and foremost, want to thank you, Ramel, for having me on. Really appreciate your time and everybody else's who's tuning in. A little bit about myself. My name is Paul Herbis. I'm an account executive too here at BEquityTrust Company. I reside in Sioux Falls, South Dakota, where we're actually chartered with the South Dakota Division of Banking. I have been married for many years and have two beautiful children, two girls, one at 4 years old and one at 6 months old. Something I enjoy is following the NFL and NBA pretty rigorously. I'm a Minnesota Vikings fan and Timberwolves fan, so you'll have to give me some grace there. certainly some trying times for us in the Minnesota sports community, but yeah, very excited and fortunate to speak with you today about self-directed IRAs and the ways that we can use these tools and the ways that savvy investors have used these tools for the past 50 years to mitigate taxes and build some generational wealth.
Thank you, and give yourself some grace. You guys pulled a magic act with the Vikings resurrecting Sam Darnold's career, so that deserves a lot of credit on its own.
That's true. We were very fortunate to have the season we did. A lot of fans weren't expecting that, so pleasantly.
Yes. So let's just kick it right off. Can you explain what a self-directed IRA is and how it differs from traditional or Roth IRAs in terms of investment options?
Yeah, so I would absolutely love to. So that self-directed IRA term is a buzzword in our industry and one that certainly even gets thrown around in the traditional investing industry as well. And that's really what it is it's a buzzword. The IRAs that we custody and administer have the same exact rules as any other IRA out there. What really differentiates is who is that administrator and who is that custodian, and can they really administratively get these investors into these self-directed investments. We differ from a lot of those custodians that you might see at the halftime of a Super Bowl show or something to that effect, as they're really concerned about their assets under management. They want to ensure that you're investing into their mutual fund or offering. Because there's an incentive there. Those are assets that they direct. Where at our institution, we built our business model the past 50 years off of doing what these traditional financial institutions won't, which is meet people where they're at and empower people to invest into what they believe in doing and allow them to transform their communities and see great returns and get into the private equity market as compared to limiting them to those traditional investments. So really a self-directed IRA is an IRA like any other. It really just matters what custodian you're working with to ultimately unlock the ability to invest into other things.
That's great to hear because as someone who's currently managing a fund that's investing in alternative assets, we know the traditional IRAs wouldn't invest in such a type of fund like that. So,
Right.
what type of investments can someone hold within a self-directed IRA, and how can investors use them to diversify their portfolios?
Yeah, great question. So anything that's not life insurance or S corporation stock, you can use your IRA to invest into. So we'll see a wide array of different investments that our investors will hold. As we're talking about today, private equity, real estate is going to be by far one of the largest assets our clients invest into. Outside of that, it would be real estate property. So properties that um, people are going ahead and acquiring, whether that be land, commercial, residential, or the like. And then other areas as well. Notes are also very popular, and lending, especially in today's given market. People will want to go ahead and play the bank and will loan out their IRA funds that way as well. Some secured against real estate, some unsecured, but many other assets as well. Foreign exchange trading, futures, commodities trading, trading the spot price of those items, precious metals, gold and silver, and investing into those arrays are another venture that we'll see people go ahead and invest to, and then cryptocurrency as well. So a wide array of assets that we'll see our investors get placed into, with of course my favorite being real estate, as is not typically a volatile of asset as others are, but yeah, certainly many options to go ahead and get placed, and many more outside of what you would find in the traditional public market.
That's great that you have the opportunity to direct your own retirement account into investments that you like or are interested in, and have a different growth trajectory from the stock market. So, how exactly can someone take a self-directed IRA and invest it into an alternative asset like
Mhm.
hotels or real estate?
Mm. It would first be finding that custodian that can self-direct assets. So working with an entity like ours to go ahead, establish an account with us. We'd then be able to assist you with the transfer or rollover process, depending on if you're moving funds maybe from a former employer 401k, as many people do, or maybe you're moving from a different IRA at a typical traditional financial institution. Certainly something that we could help assist with. After funds have arrived at our institution and after the investment's been onboarded with us, you would then go ahead, complete any necessary investment documents, give us a verbal authorization, and your IRA would then be vested into that offering.
That sounds pretty straightforward. What are the key tax advantages
Mhm.
or potential pitfalls investors should be aware of when using a self-directed IRA for alternative investments?
Yeah. So one of the biggest advantages that I'll see is the fact that with these retirement investments, you're not paying capital gains taxes on that investment's return, which is by far a powerful thing. I mean, to the point where I'm working with investors who are certainly above age 59 and a half, which is the age when you're not going to see any early penalties for taking distributions and taking those retirement funds as personal cash. I'll work with plenty of clients who, rather than take those distributions, would rather invest with their IRA funds, since they will be able to generate those returns without any of that capital gains taxes. So it is a very savvy way to go ahead and invest, especially when you're not losing out on the back end when that investment returns. A pitfall that I would caution investors to be aware of when self-directing IRA funds, is ensuring that they know who they're interacting with. So as pertains to IRAs and transacting with IRAs, there are rules with prohibited parties. So it's important to be aware of those parties that you are able to transact with and that you're not able to transact with. So when it comes to IRA investing, and let's use myself as an example, my IRA account would not be able to transact with myself, my spouse, any of my direct ancestors, so my parents, my grandparents, my great grandparents, and then any of my direct descendants, so my children, their spouses, so my future son and daughter-in-laws, and then any of their offspring. So my grandchildren, my great grandchildren, their fourth. As long as I'm not transacting with them, we're in a great spot. Then we're not committing a prohibited transaction. Now, what parties can I transact with? I could transact with an uncle and aunt. I could transact with a brother or sister, because the IRS doesn't think that those parties are going to be doing me any favors. Ultimately, at the end of the day, so important to be aware of this when making investments. In the private equity world, this rarely comes up. Maybe if somebody has a close relative working for that private equity company, this may be something they want to be aware of. But typically, we'll see this come up with real estate property transactions, and very, very seldomly in the private equity world.
That's very interesting. No, you can invest in your brother and sister.
You can. They're not going to
That's
do you a favor. They're not.
that's
They're going
really
to charge you.
interesting.
They're going to charge you full price, just like you're back on the schoolyard and you're trying to trade lunches. I mean, they're not going to do you any favors, and that's really the stance taken. So, yeah, just important to be aware of who your IRA is transacting with. And if you're self-directing your IRA, you're probably very familiar with who you're going to be making that investment with, or at least that entity. And I'm sure you'd be aware if you had any family working there.
Right, exactly.
Yeah.
So, what, if any, are the contribution limits and funding
Mm,
rules that investors should consider when
yeah.
looking to grow their self-directed IRA accounts?
Yeah, so the funding contribution limits for those traditional and Roth IRAs are going to sit at $7,000 here for 2025. There is a catch-up contribution of $1,000 if that taxpayer turned 50 or older in that calendar year. So certainly they could go ahead and contribute that every year. I would encourage them to contribute early and often. Um, we'll actually see that most investors who contribute in January do much better than those who would contribute after the fact, because they allow compounding interest to take effect, and they allow the money snowball, as I call it, to really build momentum as it approaches downhill. Um, they're able to create either compounding interest in the absence of taxation with the Roth IRA, or in a tax deferred environment with the traditional IRA. Um, so certainly something that I would encourage investors to do. A common misconception is that those contributions can only be made at the end of the year. Um, Certainly something that isn't true. They actually can be made up until that tax deadline of the following year. So if you hadn't actually gone ahead and contributed for 2024, don't worry, there's still time. You could still do so until April 15th. So just a misnomer that I want to make sure I throw out there as well.
Now that's good. So when you say a $7,000 contribution, that's what you can add to it, not how much you can roll over, correct?
You got it, Ramel. So that is a great distinction you just called out. So that's adding to it. You're exactly right. That's just putting money away into that retirement account. When it comes to doing those 401k rollovers or moving funds from IRA to IRA account, there's not going to be a limit in terms of monetary amount. So you could I've seen people roll over millions of dollars from 401ks. I've seen people roll over thousands of dollars and anywhere in between. Um, Now, in regards to rollovers, moving from a 401k account to an IRA account, there's two different ways to do that rollover. One is a direct rollover, which would be done from institution to institution, and one would be known as an indirect rollover, where that taxpayer would actually serve as a middleman, would receive the check to forward to that financial institution. The indirect rollover you can only use once every 365 days. Direct rollovers can be used as many times as you see fit. I will always encourage direct rollovers when moving funds from any financial institution to ours, just to ensure that that client and investor does have that indirect rollover in their pocket. Shall they still need it?
Have you ever stayed in a hotel and thought, what if I owned this? What if you could move from being a guest to being an owner? Hi, I'm Ramel Lee, Managing Partner of RDL Hotel Fund I. We've created a unique opportunity for people like you to invest in hotel ownership, an asset class once reserved for the wealthy elite. Hotels, especially economy extended stay properties, are resilient and generate cash flow even during economic downturns. With as little as $10,000, you can join our movement to democratize wealth and create opportunities for your future. This is your chance to build generational wealth. Don't just stay in hotels, own them. Visit us at www.rdlecp.com to learn more and take your first step today. So regarding the rollover,
Yeah.
if you roll over from one account to the self-directed, do you have to roll over the whole everything in the other account, or you could roll over some of the funds from the other account?
A great question, Ramel. I actually was meeting with a client earlier today regarding that. So you can move any amount. It could be a partial. You don't need to move the full account over. You could elect to move a portion of the account or all of it. Some investors will start out with moving a portion and then will move more over time as other investments become available and as their appetite continues to grow in the worlds of private equity. But really, it's going to be up to that taxpayer. They're going to have full control over how much funds they want to move over. Some people will move a portion as a way to hedge, and other people will move it all over when they leave. Perhaps change an employer is a very common time people will choose to start that self-directed IRA.
Great information. So, what are some common mistakes investors make with self-directed
Mm.
IRAs, and how can they ensure compliance with IRS regulations to avoid penalties?
No self-dealing. That's what I would first and foremost say. So, use an example here. Let's say I own an acreage of real estate. I own it personally in my name, and I have this great idea that my IRA should buy that real estate from me, and I should pay myself out of my IRA and move funds to myself personally, and move that real estate into my IRA. It can't be done. I already personally own it. Um, so we want to ensure no self-dealings going on. First and foremost, that it needs to be for investment purposes, and it can't benefit me personally for that investment. So really important to understand and be aware of. Other common mistakes I see with self-directed IRAs are people going ahead when they're opening up that self-directed IRA and when they're investing with somebody. To ensure they're not investing with that family member, right? I mean, I know we touched on prohibited parties earlier. I'll typically see this with real estate property. Everybody wants to transact with their parents. Everybody wants a sweetheart deal. Can't happen with this IRA, right? I mean, this isn't a way to move funds out of your IRA. This is an investment use, and then personal use too. That's something that I want to speak to as well. You're not able to personally benefit from that IRA investment. So let's say if I go out tomorrow, I purchase a single family home down in Florida because I'm located here in Sioux Falls and it was negative 16 degrees yesterday, and I've had enough of it. I want a snowbird like everybody else. It's finally just starting to click for me. I'm finally just starting to get it. So I purchased it with my IRA. Say I want to head down this weekend and use it, stay there with my daughters, I would not be able to because my IRA personally owns it. I'm not able to personally benefit from that IRA's investment. So important to keep in mind when making those investment decisions. There are ways to move property and move it out of the IRA into your personal name, known as an in-kind distribution. So there's ways to shift property out of that IRA back to yourself personally at the end of the day, but is not to be used for personal use, and something I see as a pitfall. Which
Understood. And just so you know, it snowed in Florida a couple of days ago.
there's nowhere
Yeah,
safe. There's nowhere safe.
Yeah,
It's
yeah, it snowed in Florida, and someone just told me that there was 3 to 4 feet of snow in New Orleans.
oh
Well,
my goodness, it's
I
backwards.
didn't even know it could snow in New Orleans, and they said they lived there, and they said, "Me neither."
There's
So,
more snow in the ground in New Orleans than there is up here in South Dakota right now. That's
yeah,
incredible.
that's wild. That's wild. So, yeah, so you wouldn't have to, worry about using it for personal use to avoid the snow.
Man, I'll have to look at some foreign countries then, and yeah, my goodness, that's incredible. But um, yeah, lots of good knowledge here, Ramel, and these are some phenomenal questions.
No, no, I mean, the answers are great. Like, me and my community, we're learning so much from this. So what strategies can investors use to
Mm,
leverage their existing retirement fund to
mm,
fund alternative assets, while maintaining a balanced portfolio?
yeah, um, it's a great question. So diversification, that's the main reason, the main strategy I see this used. Too often, or do people have all their eggs in one basket? And I mean, when I say too often, I'm talking about most people in America. I mean, most people in America, their retirement funds are sitting in a mutual fund or in the S&P 500, and they have no idea where it's invested into. I mean,
Right.
there was a client I met with last year who was, I won't say the name of the institution, but they were invested with a large custodian. Everybody's heard of them, and they were invested into an international real estate fund. I asked them what countries is that fund invested into, and they had no idea. They turned around and asked their financial advisor, and not a clue, right? So um, it gives people control, and that's really why I see it commonly used is it's a way to invoke a personal strategy that you believe in, whether that be a deal that you're very confident in, that's penciling great, or with somebody that you really trust, admire, and in who you think will generate a great return for you. That's really where I see those strategies used. Is let's get this money off Wall Street. Let's let's get this into the hands of hardworking people we know, like, and trust, where people are seeing better returns. I mean, if you go ahead and pull up a if you go ahead do a Google search on the S&P 500 in the last 20 years and returns into private equity groups, I mean, you can easily see that those returns have been greater. So diversification, I think that's a terrific reason that in strategy people will go ahead and elect to use this, because they don't want every single egg in this mutual fund basket. They want to pull some over into the private equity world and actually be hedged and be diversified. So that would be the number one strategy that I would commonly see used. Another strategy I see used all the time is that of a Roth conversion. So for those people who have pre-tax funds sitting in a traditional IRA, maybe it's sitting in a SEP or simple IRA if they had worked for a smaller employer who had a different plan set up for them. Say those people are looking to convert to post-tax dollars. That's a strategy I'll see commonly used, where they would do what's known as a Roth conversion. They would go ahead and pay occur a taxable event. They would pay any applicable taxes on those pre-tax funds that they're looking to shift to a post-tax status. And in doing so, the logic and thought process behind that is, have you ever heard of taxes going down? um, I haven't. I implore somebody to find me an example where they have, and I I uh, I would welcome the opportunity to be proven wrong. But that's a big part of it. Is taxes will continue to rise. They historically have. Let's go ahead and pay the piper now. Another mode and thought process of that is that when they're looking to draw upon those funds at 59 and a half, they're going to be in a higher tax bracket. So they want to go ahead, take care of that taxable event here and now when they're falling into that lower tax bracket, rather than take that hit when they're 59 and a half and they are looking to start dipping into their savings that they've worked hard and contributed to over a plethora of years. Um, that would be one of the more common strategies I would see used for sure.
Great, great. I'm a big proponent of uh, investing in things that you like, things that you love, things that you're willing to learn about. So you're not relying totally on like you said, a phantom manager managing your money and you having no idea what's happening with it. So,
That's that's it. At the end of the day, it's typically like somebody's financial advisor, and from what I hear from all these people, oh, it's my college roommate, or oh, it's my high school friend, and that's great. They could still be your friend without necessarily assets under management. There is I applaud people's loyalty in regard to some of their financial advisors, but at the end of the day, you're exactly right, Ramel. I mean, people don't know where their money's being invested. Maybe their account looks like other clients I've worked with, and they're not generating returns. Well, here's a way to take that stagnant dollars and actually get it to work for you.
yep. So let me ask you this. I know we're discussing self-directed IRAs, but do you know some alternative ways individuals can fund investments?
Yeah, and in terms of real estate, a 1031 exchange would be a great one. Another service and product we offer, and it's going to apply directly to real estate and real interest in real property. So this would be a way under Internal Revenue Code Section 1031 in the IRS tax code that someone would be able to defer capital gains taxes for the sale of their real estate if they're looking to reinvest it. So uh, a great way that people could go ahead, take advantage of our tax code as it applies to real estate, take what they would have paid in taxes, go ahead and roll that into their next investment.
Right. And listen, as the adage goes, it's not how much you make, it's how much you keep. And taxes is the biggest eater of your income. So
There's
yeah.
it, there's no it's not a coincidence I live in South Dakota, Ramel, where we don't have state income tax. It really isn't. There's no coincidence there, and I couldn't agree more. Well said.
So your company is a custodian for self-directed IRAs. How important is selecting the right custodian for a self-directed IRA? What should investors consider when choosing one?
Yeah, experience matters. I mean, I'll call that out first and foremost, and that's something that we certainly offer. I mean, we've been in business now for 51 years. Um, we came about in '74 when the ERISA Act did, and IRAs became a thing. So we're the largest custodian of alternative assets. Um, in currently custody $57 billion of assets. So one size doesn't fit all, and I totally understand that for investors, but I'm very partial to our entity. We do a wonderful job when it comes to servicing our taxpayers, and that's certainly something that I think sets us apart from every other custodian is our response and our ability to actually pick up the phone when people call, and our ability to problem solve and get people funded quickly. I mean, efficiency is where we operate, next to the corner of ensuring our clients are satisfied. So when it comes to picking a right custodian, I think an important factor would be response time, experience, as well as those who understand the importance of this. I mean, this is somebody's nest egg that we're talking about, these retirement funds. I mean, typically this is something that somebody has contributed to for decades, and not something to be taken lightly, which I know is something we certainly appreciate. So, um, experience, Ramel. Yeah,
No, and I personally can vouch for your responsiveness. Like you're always like you're very responsive and it's very much appreciated. So I can vouch for that personally.
thank you.
Uh, for, for someone that's new to self-directed IRAs, what key steps would you recommend to getting started and avoid common challenges?
Ask questions. I think curiosity is really where it all starts. I would ask for that individual to reach out to me, and let's start a conversation. Let's start a dialogue. Because once when we start that dialogue, and once when we start asking questions, that's when we're going to start finding knowledge. And we might not ask the right questions right away, and that's okay too. But those first questions are going to get us to those in-depth ones, where I can really start to see some wheels turn in and some light bulbs pop up. Um, So the first step I would recommend is to reach out and to start that conversation and to start that dialogue with me and to start asking those questions.
And if someone wanted to reach out to you to get more information, how can they get in contact with you?
Yeah, the best way to get a hold of me is my personal cell number. So 605 8620 would be the best number to get a hold of me via call or text. Um, could also be reached via calendar. Um, I do have a Calendly link that someone could use to book with me, or I'm always available via email too, which is just my first initial here, P, with a period, and then my last name right there at trustetc.com.
That's great. That's great. Well, Paul, thank you so much for your time and the wisdom that you shared with us. I know that a lot of people have reached out to me about uh, rolling over their IRA into a self-directed to invest in RDL Hotel Fund One, and uh, and I'm sure after this there'll be more people calling you and reaching out.
I appreciate the opportunity, Ramel. Really want to thank you for having me on the Economic Empowerment Podcast today, and yeah, want to thank you for your time, and yeah, would really appreciate the opportunity to assist.
Thank you. Thank you. All right, everyone, you got it. You can reach out to Paul directly to find out more information about self-directed IRAs, and you can reach out to us more about the economic empowerment in the RDL Hotel Fund. All right, everyone, take care.